Good afternoon, guys. In light of the big game yesterday, one of my favorite quotes from Vince Lombardi states, "The only place success comes before work is in the dictionary." So I wanted you to hear that, but I hope you're doing well, healthy, happy. I really appreciate you guys and gals for being here for this week's Market Pulse update, where we're going to review the national housing market and take a peek into what's happening into the economy. So let's dive right in. Reviewing last week, traders paused from their upbeat activities since the start of the year as stocks fell for the week on disappointing Q4 corporate earnings and economic data and hawkish comments that also came from the Fed. Chair Powell said the Fed has a significant road ahead to get inflation down to 2%. The trade balance revealed a global trade slowdown, and the Treasury budget reported a $38 billion deficit versus a $118 billion surplus just 1 year ago. But low initial jobless claims indicated the economy could still see a soft landing, and the University of Michigan Consumer Sentiment Index rose to a 13-month high, showing Americans are cautiously optimistic. The week ended with the Dow down 0.2%, the S&P 500 down 1.1%, and the tech-heavy NASDAQ down 2.4% for the week. Had a pretty good little run today, though. But bonds overall fell sharply. The UMBS 5.5%, dropping 1.01 to $100.11. Freddie Mac's primary mortgage market survey reported a ever so slight increase in the national average 30-year fixed mortgage rate. And guys, you got to remember, mortgage rates can be extremely volatile, so check with your mortgage professional like Chuck Barone for up-to-the-date information. Something that was quite amazing was that the CPI report was revised higher for Q4 from October through December. Higher, and what was actually revised were the seasonal adjustments and thereby the seasonally adjusted month-to-month CPI readings that everyone is talking about as a measure for the current inflation, whether it's accelerating or whether it's slowing down. Now, the services CPI was revised to a red-hot plus 0.7% for December from November, originally 0.6, and it was also revised up for November and October. And I'll put a chart here on the screen for you guys. Red is after the revision, and green was before the revision. The core CPI was also revised up for October, November, and December, showing much less disinflation in October and November and accelerating inflation in December. The revisions also took out some of the spikes in 2022 and 2021. So see the chart right here on the screen. I'm going to put that up for you guys. As I was doing some research on the topic, I read a quote from an English economist and philosopher who lived from 1883 to 1946. And the quote is, "The market can remain irrational longer than you can remain solvent." Okay? The market can remain irrational longer than you can remain solvent. And I thought that quote was very interesting because when nothing seems to be right and everything goes in one direction when it shouldn't be, it can last longer than you and I can. But anyways, in other economic news, big inflation report is due tomorrow. All the market eyes tomorrow will be on the release of the Labor Department's CPI, Consumer Price Index, which is a widely followed inflation gauge. But guess what? They might have to revise this one too. Economists are expecting the CPI will show a 0.4% increase in January, which would translate into 6.2% annual growth. However, there is some indication the number could be even higher. With the Fed keen on fighting inflation, this report could actually harden their position. Now, moving into Treasury bond yields, we have seen large increases from last Monday's reading. The 30, 10, 5, and 2 all increased double-digit basis points, with the 30-year sitting at 3.792%. That's up 12.7 basis points from last week. The 10's at 3.719%. That's up almost 12 bips. The 4-year higher than the 10 and the 30, and an astonishing 18 basis points to 3.92%. to 3%, and the 2-year trumping the other three yields at 4.534%, and that's up almost 16 bips week over week. The 2 and the 10-year spread, it grew larger, up another basis point. It's at 81 basis point spread. Look at this chart I'm going to put up on the screen. Going back from 1982, we have not seen an inversion like this ever since 1982. And if we have, I'm not seeing it. Let me know what you guys are thinking about this recession indicator in the comments. All right, let's move into the national housing market. We have quite a bit of information for you, so go ahead and grab your pen and your pad and take some notes. Black Knight reported purchase loan locks went up 64% from the first to last week of January. That's the largest jump in 5 years, as well as a growing trend of home buyers paying points up front to permanently reduce their mortgage rate. Now, while daily Optimal Blue rate lock data showed modest signs of an early January rebound in purchase locks, refinance lending remains challenged, and that's despite a full percentage point rate decline since the October 2022 peak. Now, in the third week of January, 57% of borrowers locking in rates paid at least a half point as part of a permanent buy down. 44% paid at least a full point, and nearly a quarter bought down their rates with 2 or more points. Overall, borrowers paid an average of 1.25 points, down from the peak of 2.03 points last fall, at an average cost of $4,300 per borrower for the week ending January 21st, 23 versus $6,900 for the week ending October 1st, 2022. The Mortgage Bankers Association saw mortgage applications increase 7.4% last week, noting purchase activity that was put on hold last year is gradually coming back as rates ease and housing demand remains strong. Freddie Mac's chief economist observed that with the recent rate drop for the 30-year fixed-rate mortgage, interested home buyers are easing their way back to the market just in time for the spring home buying season. Single-family existing home sale prices climbed in almost 90% of measured metro areas, 166 of 186 in the fourth quarter. The national median single-family existing home price increased 4% from 1 year ago to $378,700. The monthly mortgage payment on a typical existing single-family home with a 20% down payment was $1,969. That's up 58% year over year. Less than a fifth of the metro markets, 18%, posted double-digit annual price appreciation. 46% was the previous quarter. A little did you know that the NAR reports the median sales price for single-family existing homes climbed 4% in Q4, a deceleration from Q3's 8.6% increase. Plus, around 1 in 10 metros across the U.S. saw price decreases. Now, here's some free game for all of you with the real estate tip of the week, and it's how to win as a buyer in today's housing market. First, you're going to want to make sure that you have a trusted professional on your side, including your local real estate agent and your local lender. If you need a referral for an agent or a lender, just let me know. Send me an email, call or text me. Or if you're looking in Southern Nevada, do not hesitate to connect with me. My contact information is down below in the description of this video. Now, the pros you hire, so choose them wisely, will have the skills you need to move quickly and efficiently. You will want to make strategic plans, so be careful when budgeting and planning for your down payment. These are very, very key. Think about your wish list and prioritize what you need. Third, consider what is in and what is out of bounds. Figure if you want to stay in the same area, or maybe you want to branch out to new communities or a different neighborhood. Go ahead and make a list of the neighborhoods that you would like to live in. And fourth, stand out from the crowd by being pre-approved for a mortgage. It shows the seller that you're serious and qualified, you're a serious buyer, you're ready, willing, and able, and lean on your team's expert advice to draft your strongest offer possible. Now, in today's housing market, you can still be the champion if you have the right team and strategy. So go out and make it happen and let me know how I can help you. All right? As we wrap up this week's edition of the Market Pulse, we will have this week's predictions, and here they are. It's that January housing starts are expected to be a tad off, but building permits should be up. That's a positive sign for future activity. The January Consumer Price Index, the CPI, is forecast to show a gain in inflation, while the Producer Price Index, which is wholesale, or PPI, is predicted to report the same for wholesale prices. But ending on a good note, January retail sales are expected up after December's decline. U.S. financial markets will be closed next Monday, February 20th, in observance of President's Day and George Washington's birthday. So I hope you guys all enjoy your holiday weekend. Now, in closing, we are forecasting Federal Reserve policy because the overnight rates set by the Fed, it affects our industry tremendously. Now, with that being said, Fed watchers expect the Fed to keep its foot on the gas with a 0.25% rate hike in March and another one in May, and then they're going to put the brakes on in June. The current rate is 4.50% to 4.75%, and Wall Street is expecting a 25 basis point rate hike after the March 22nd Federal Open Market Committee meeting and another 25 basis points after the May 3rd FOMC meeting. Fed Chairman Jerome Powell has said they want rates over 5%. He said that publicly, and the May 3rd meeting would put the rate at 5% to 5.25%. Wall Street is expecting a pause at the June 14th meeting, but we're going to keep you guys informed every week as to what the consensus is amongst Wall Street. Again, I appreciate you guys being here. It's Monday, February 13th. Happy Valentine's Day to all you lovebirds out there. I hope you guys have a great rest of your week. Hope everything's going well for you. And if I can be of any help or service or assistance to you, your friends, your families, colleagues, please feel free to reach out to me at any time. Okay? Take care. I'll talk to you next time.